unless I have an issue, Darren. I know both of us are major IT experts,
Yeah.
but I think I'm good to go.
So maybe I told you guys this story. I have two daughters in college. One's a senior at USC and one's a sophomore at Boulder. And totally two different girls. I get a text, this was last week or a week and a half ago. I get a text from Mia, who's at USC. Hey, Dad, I need to get my Schwab account diversified a little more, talking about her stocks and just really, that's her major is in finance. Want to get this diversified and just going on about all the stuff she wants to do with her Schwab account and stocks and everything portfolio, which was great. I loved it. Texting her back, we're going back and forth. And then about 15, 20 minutes later, I get a text from Ava, the sophomore at Boulder. Hey, Dad, I need you to pay my sorority bill. That's the two personalities of my daughters, sorority bill and Schwab.
Stock diversification.
Yeah, that's great. All right. I think that's about it. If more come in, I'll just let them in as they come. So welcome everyone to our monthly realtor call or events call, just to talk about whatever it is we talk about every month. I mean, we've gone from having top realtors talk to us about what they do to appraisers to AI stuff, all kinds of stuff. So this month we have Mr. Brian Peterson, who I met, gosh, I feel like I've known you a long time, but it's only been maybe, about a year or less than a year.
Less than a year, yeah.
And Brian's a tax pro, and I'll actually even plug a little bit because I had a tax guy that I've used for years and years and loved him to death. But when I met Brian, we started talking about stuff, and he grabbed our taxes for 2024 and just did a great job. A lot of stuff that we didn't catch years prior, just did a wonderful job. So thanks again, Brian, for that. I appreciate it.
Well, Darren, happy to be of service.
Yeah. So what we want to do this month is talk about the one big beautiful bill. And let me just get up all right. So let me just read a little bit about Brian here for you. Oh wait, here comes Megan. Megan, meet Brian.
Hi, Brian.
Welcome to the call.
Hi, Megan.
All right. So here's a little bit about Brian. Brian Peterson is the chief bean counter of Big City CPA, a virtual tax practice based in the beautiful city by the Bay. Brian founded Big City CPA to focus 100% on marketing a positive impact to the financial futures of people and small businesses, and to spread the word on the significant benefits of investing in residential real estate. Outside of the office, Brian has traveled to 30 countries, ran 6 full marathons. Number 7 is less than 3 weeks away in Chicago, and rocked out hundreds of concerts, domestically and internationally. What kind of music, Brian?
Hard rock, heavy metal, wide range.
Yeah, there you go. And he's here today to break down the one big, beautiful bill for us. Please join me in welcoming Brian Peterson, CPA. So welcome, Brian.
Thank you, Darren. Great to be here. And I'll go ahead and share my screen. Darren, are you able to see that okay?
Yeah, I can see it.
Okay. So I have my contact information here up front, but I know I've met, I think, a few of you at either buy, sell, or BNI meetings. So good to see everybody. And okay, does the screen move?
Yes, we're good.
Okay, great. All right. So I'm going to just talk about myself very briefly after that wonderful intro by Darren, and then we'll talk tax. So yeah, I'm a CPA based in San Francisco. I work with a broad range of clients, people, small businesses, real estate investors, and I also invest in real estate and am grateful to own multiple single family homes around the country. So I started to advise my clients who own real estate through the dual lens of both CPA and fellow investor. And so it's not about how much money you make, it's about how much money you keep. And my goal is to help my clients keep more today and over the long term, while also staying within those lines. So today's agenda is the One Big Beautiful Bill Act. The bill is big, both in content and length. The biggest tax change in the tax law since the Tax Cut and Jobs Act of 2017. Whether it's beautiful, is subjective. I will refer to it as simply the new tax bill. And given we only have so much time and the bill is very big, I'm going to focus on the most key provisions likely to affect the most people. And I'll try to sprinkle in some realtor-centric, if that's a word, realtor-centric commentary along the way. And there might be, one or two of you who heard me speak at the BNI meeting last month. And so, much of this is going to be repetitious of that. It's always good to hear this stuff twice because there's a lot. But I'm going to also cover some things near the end that we didn't get to at that meeting in terms of some commonly overlooked deductions. Okay, I like this quote. Did you know there are 2 tax systems? I mean, I would have thought that one was more than enough. But I like this quote: one for the informed, one for the uninformed, both are legal. And hopefully you leave here today with some good takeaways. The name of the game is leveraging the new tax law to your advantage so you can save some money. So the new bill was signed into law on July 4th, Independence Day, following 2 months of political theater in Congress, where it was passed through a method called the budget reconciliation process. So what's in the bill? Well, as it pertains to tax policy, the new bill is really doing four things. First, at its core, it's simply extending many provisions that were currently in place that were otherwise set to expire at the end of 2025. So, and we'll cover those in a moment, but along with some key modifications you'll probably be interested in. But you'll hear the term also in the media that it's this bill permanently extends things. It's permanent, it's indefinite. And that can be kind of misleading because permanent just simply means there's no expiration date as of today. Taxes are always subject to change in the future by future bills, future Congress, future presidencies. Nothing is truly permanent, with the known exception of paying taxes and maybe dying. Maybe those two things. But for now, this will be the law. Second, it reinstates some favorable business incentives that I'll touch on. Third, there are some brand new deductions that link back to the presidential campaign. And then fourth, it repeals energy credits and incentives from Biden's term, which was expected, but disappointing because there were some good tax credits there. What's not in the bill? Well, it does not directly eliminate taxes on Social Security because you can't do that with the budget reconciliation process. But there is something helpful to seniors that I'll touch on. And there were many proposed expansions for health savings accounts, HSAs, that were in the initial House bill back in May that did not make it into the final bill. But like the bill, dislike the name. The key thing to keep in mind is it provides clarity for going forward. Because absent this bill or a bill, the entire tax code would literally be turned on its head on January 1st of 2026. Because there's a whole bunch of stuff that would be reset to pre-2018 tax law. And that's a long time ago. I mean, 2017 is a long time ago. That's like 3 years pre-pandemic. Who can remember back that far? So let's dive into it. Okay, so starting with some individual tax provisions, very important. The current 7 tax brackets everyone has come to know and love the last 7 years have been permanently extended. And again, permanently means it's just for this foreseeable future, which ranges from a low of 10% to a top rate of 37%. The income ranges within each bracket are adjusted annually for inflation, but the actual rates are fixed. And absent this bill, everything would generally increase on January 1st of 2026 because they would revert to the tax brackets from 2017, which had a top rate of 39.6%. So prior to this bill, again, 2026 was kind of a black hole in terms of tax law and tax brackets. No changes to rates for long-term capital gains. So it's business as usual there. So for people selling stock or selling real estate, selling homes, there's nothing that's changed there. It's still the same tax rates, long-term capital gains. By the way, do you know what your top federal tax rate is without checking your tax return? It's like, well, of course I do, Brian. What a stupid question. But it's important to know that because that's how it's important to know like what your top tax bracket is and how close you are to the next tax bracket because that's where tax planning starts. And the big jump from 24% to 32% is significant and catches a lot of people off guard. So a lot of tax planning is all about how do I reduce the proportion of income that I have in my top tax bracket or get myself down to the next bracket. The higher standard deduction that has been in place since 2018, that was also preserved and gets a nice bump for 2025. So for example, married filing jointly taxpayers, it was $30,000, now it's $31,500. There's a new deduction for seniors of up to $6,000 single, $12,000 married, which contributes to reducing taxes on Social Security. But there are income phase outs that start at $75,000 for singles and $150,000 for married, but it's a very gradual phase out. But this is an example where like you're kind of thinking ahead to retirement, depending on how close you are. This is an example of like where things like Roth IRAs can be very impactful because Roth withdrawals in retirement are not taxable income, because you're already taxed on the original contribution. So that can help keep your income for tax purposes below that $150,000. You can fully leverage this deduction. Ditto for investing in real estate. Oftentimes, because of the way the real estate laws work for rental properties, a lot of your rental income is usually offset by expenses, including depreciation. So you can be in a situation where you have all this cash flow coming in retirement, whether it's through real estate or through Roth IRAs, and not count it towards your taxable income. So things to keep in mind. And this, by the way, that new deduction applies for seniors taking senior standard deduction and seniors itemizing deduction. So either or. The higher tax credit for children, the child tax credit that's been in place the last several years, it was also extended with a nice $200 bump this year. There's some income phase outs there that apply. But and that applies only to kids under the age of 17. So if you have a kid that turns 17 in December, then they would that credit would not be allowable. And by the way, a deduction reduces taxable income. A credit reduces your tax liability dollar for dollar. So you might say, okay, well, $2,000 to $2,200 for the child tax credit, big deal. It's only $200, but that's $200. That's $200 of actual tax savings, which, if you have a few kids, can add up. So now let's move on to SALT, which I think is the biggest news for millions of taxpayers this year, especially higher tax states like California. And so I just first wanted to take a moment to get regrounded on what SALT is and why it's important. So SALT stands for state and local taxes, which for most of us is state income tax as well as property taxes on your primary residence. And SALT would be relevant if you itemize your deductions. And you'd itemize deductions if they exceed the standard deduction. So this year, the standard deduction is $31,500 for married filing jointly. So the usual suspects for itemizing would be mortgage interest, charitable donations, and SALT. And if just going back in time to 2018, if you recall, starting back then, the prior tax act that was in place capped SALT at $10,000. Previously, it was unlimited. So that translated to a tax increase for higher tax states like California, because you can basically do all of jack shit with a $10,000 SALT deduction in California, right? People went from being able to deduct $40,000, $50,000, $60,000 to only 10. That was a big deal. But with the good news is that with the new bill, that cap has been temporarily raised to $40,000, an extra $30,000. This is effective for 2025, meaning the upcoming 2026 tax season. So most Californians who itemize deductions will likely see a nice tax reduction there. The bad news is for those of you with incomes over $500,000, that incremental $30,000 deduction phases out rapidly between $500,000 and $600,000. So incomes over $600,000 are left with the original $10,000 SALT and would not benefit from this new increase. Let's do an example. So I can't think of two finer people to illustrate the SALT deduction than Mort and Morton, great people, the Mortons, and they have respectable joint income of $475,000. They own a home in Mill Valley, and their total potential deductions for itemizing are $90,000. So that's that first column there, with the usual suspects. So mortgage interest, charitable donations, and SALT. And so $55,000 is SALT. And without the new bill, so if there was no new bill, this year, the SALT would be limited to only $10,000, which would, for them, leave $45,000 on the table, right? Because they have $55,000 total SALT. They can only take 10 of it. So it's $45,000 that they can't use. But now with the new tax bill, they can take the full $40,000, leaving only $15,000 on the table. So after itemized deductions, their taxable income, so their total itemized deductions between mortgage interest, SALT, charitable donations, $75,000. So their taxable income is down to $400,000, whereas it would normally be $430,000 under the old rules. So that equates to a $30,000 reduction in taxable income, and they're in the 32% tax bracket. So that would be $9,600 of tax savings. So for your clients who are currently renters and on the sidelines about, do I buy a home? Do I not buy a home this year? What am I going to do? You can see how it may be beneficial to, have at least a baseline knowledge of the SALT deduction with the enhanced SALT, because that's just good incentive. Like, hey, if my income is below $500,000, I'm buying a new home. Boy, I can really get some good deductions this year with the SALT deduction. So some tax planning considerations on that. There's really three possible categories. So it's good to know where you stand in these three buckets. So number one, you're either already itemizing and you're under $500,000. There's a good chance the increased SALT is icing on the cake for you. And you can, if you're in the 32% tax bracket, that's potentially $10,000 of savings. Number two, if you've been taking the standard deduction, consider whether it's beneficial to itemize this year. Even if you rent versus own your home, for people who, many renters in San Francisco pay state income tax that exceeds the standard deduction. So there's oftentimes those people who are assuming that they'll just take the standard deduction who could benefit from itemizing. And some of you may be itemizing for state and taking the standard deduction for federal right now. That's a very common scenario in California, just because the itemizing works differently for California versus federal. So you could be a situation where you're itemizing for state, standard deduction for federal, and then this year the question is okay, can I itemize? Does it make sense to itemize for both? And if your income is trending between $500,000 to $600,000 or a little above, this is a very good time with Q4 just around the corner to review your income sources with your CPA and identify opportunities to reduce income this year or next year in order to more fully leverage that SALT increase. Especially for those of you who might be, if you're 525 or 550, boy, what can we do to get you below 500? And a great example is maxing out contributions to your retirement plans, which both lowers your income and the portion of your income taxed at your top rate. So it's a win-win. By the way, for any of you who own rental properties, the SALT deduction does not apply to rental properties. Property taxes for rentals can be fully offset against rental income. So these same restrictions don't apply. And then I'm not going to go into the bowels of this, but for anyone who has an S corp, there was a SALT workaround in place called the Pass-Through Entity Elective Tax, or PTET, which basically allows the corporation to pay state income taxes and deduct it on the corporate return, and that reduced income then carries over to your personal return. But this even with the increased SALT deduction, that thing is still intact. So it's good to work with your accountant and make sure you're on the same page with how PTET will work going forward to complement the new SALT deduction. All right, other itemized deductions. So we talked about SALT. Now there's a couple others to talk about here. There is charitable contributions. So this is an example of where we have some give and take with the new bill. And I think it's Congress's way of trying to balance things out through the budget reconciliation process. But starting in 2026, next year, not for the 2025 taxes, but next year's tax return for the 2027 filing season. The good news is that non-itemizers can deduct charitable donations of up to $1,000 single, $2,000 married. Historically, people claiming the standard deduction were not allowed a tax break for charitable donations. It showed up briefly during the pandemic, but for the most part, it's been a no-go. But going forward, starting to so if you are itemizing, I don't want to encourage anyone to defer till next year to make the charitable donation to the causes that are important to you, but just be aware that if you are standard on the standard deduction, that there will be a charitable allowance for next year. And then on the flip side, itemizers get a haircut, unfortunately. So starting again next year, you can only deduct charitable donations to the extent they exceed 0.5% of AGI. So what the heck does that mean? So if you have adjusted gross income of $400,000, 0.5% is $2,000. So that means if you have charitable contributions totaling $2,500, you can only take a deduction for $500, because $2,500 versus $2,000 is $500. So this is a good time, again, for Q4, good time for tax planning, especially for high earners. Because that floor is going to be higher the more you make. So consider, if you're itemizing deductions, consider accelerating contributions in 2025. Donate more this year, recognizing that there's this threshold you have to meet next year, and consult your wealth advisor about something called donor advised funds, which are accounts held at a public charity on behalf of a donor, and it's a way to front load donations in 2025. Take the deduction in 2025, and then choose when and where the money gets used in future years. So both Darren and I know a pretty good financial advisor that can help you make those decisions. Mortgage interest. If you're buying a new home in the year ahead, you have clients that are buying new homes in the year ahead, the $750,000 mortgage interest limitation that's been in place the last several years was also extended with the new bill. So that means for a $1.5 million loan, only 50% of your interest on that loan on your 1098 mortgage interest statement is deductible for itemizing, because $750,000 versus $1.5 million is 50%. So That limitation that still continues as is, but the good news is PMI can be factored into the deduction starting next year in 2026, which is something that has come and gone over the years, in and out, and now it's back again. So similar to SALT, this is just good information to have in your back pocket when working with your clients, because hey, they might be more comfortable putting down a lower amount, 15% on the new home, and paying the PMI going forward if they know that some portion of that might be tax deductible. And again, similar to SALT, there are no mortgage interest limitations for rental properties. So if you have rental properties, mortgage interest, PMI, everything is fully deductible against your rental income. And I always like to, someone who I have a number of 30-year fixed rate loans for my rental properties, and I'm a real big believer in the 30-year fixed rate loan. The mortgage tax deduction should never be a deterrent for getting a 30-year fixed rate loan. As far as Darren mentioned, I've traveled to 30 countries, pretty well traveled, and as far as I know, we are the only country in the world that has a 30-year fixed rate loan. It's basically, where else? It's basically an inflation-proof financial instrument. Everything else rises with inflation, but a 30-year fixed rate loan, that's inflation proof. And so no one else has a fixed term like that except the United States. So it's something that we kind of take for granted here, but it's really unique to the US, and it's a very, very powerful tool. So it's like the whole mortgage interest deduction, it's like things change over the years in terms of what's deductible and how much is deductible and what's not. But in the grand scheme of things, it's just noise, because ultimately the 30-year fixed rate loan is just such a powerful tool. Finally, phase outs for itemized deductions are back for 2026. So this only affects taxpayers in the top 37% tax bracket, essentially capping the benefit at 35%. So if you're in the 37% tax bracket, when it comes to itemized deductions, you're only going to benefit to the extent you're in the 35% tax bracket. So there's a tax planning opportunity there to look at trying to get your income out of the 37% tax bracket down to the next one if you're in that scenario. Okay, so I'm going to just pivot briefly and also just touch on a couple business tax updates. Because all of you who are 1099, sole proprietors, etc., you're business owners. So the qualified business income deduction is a small business tax break that came into existence back in 2018, and that's set to expire after 2025. The good news is that's been permanently extended as well. Basically, it reduces taxable business earnings by up to 20% if your total personal income is within certain thresholds. Depending on the circumstances, there's a lot of ins and outs that can complicate that calculation. But for married filing jointly, it usually starts to phase out around $400,000. But it is a great tax break. And here's the thing: it's like a lot of people don't really even know that it exists because it's QBID, qualified business. It's such a goofy term, and it doesn't really flow through your tax return in a very straightforward way. So, but it's a really good deduction. It also applies to if you're in a net profit position for your rental properties. This deduction would apply to rental properties as well, because rentals are usually a business, and that's just one thing I've just seen taking on new clients is that clients who've been in a net profit position on the rentals, their prior accountant was not giving them this deduction, even though they would qualify for it. 100% bonus depreciation. Bonus depreciation is back in full. And simply put, bonus depreciation allows you to immediately expense certain assets that you would otherwise deduct over the useful tax life. So the cost of a business vehicle, for example, would normally be deducted over 5 years. And so now there's ways to front load that deduction. And bonus depreciation is something that's come and gone. We last saw 100% in 2022. It was being phased out the last few years. It was 40%, just a 40% this year, but with the new bill, it's back up to 100. And so for most self-employed business, and business or small business owners, the best example of bonus depreciation is the vehicle you drive for work. And many of you, I'm sure, do a lot of driving with your business. And so the sweet spot in the tax code for bonus depreciation is vehicles weighing over 6,000 pounds, purchased, not leased. So basically, if you purchased a $100,000 SUV, say next week, you drive 75% for business versus personal, you could deduct $75,000. 75,000 is 75% of 100 against your income through 100% bonus depreciation. And a similar concept called Section 179. I'm not going to get into the Section 179 versus bonus depreciation because some of it's semantics, but Section 179 is what allows you to take some of that deduction for California state taxes. There's no such thing as bonus depreciation for California state. California state is only a federal thing. But if you were able to write off 75% of your vehicle, then you're also able to take 75% of your gas, 75% of your car insurance, 75% of your car washes, and so on. So it could be a very sizable deduction. And it's one of those things where it's like, hey, if you're over $500,000 of income and you're in the market for maybe a new vehicle, hey, it's something to consider for this year to get you to a point where you can leverage that SALT deduction. And lighter vehicles, less than 6,000 pounds, those have some limitations on the amount of depreciation you could front load in year one. There's still good tax savings there. I'm just saying that the sweet spot in the tax code is vehicles, SUVs greater than 6,000 pounds. But lots to consider here. I'm trying to keep it pretty straightforward. So definitely recommend with speaking to your tax advisor before moving forward with buying a new vehicle or purchase versus lease and all that stuff, because there's different ways to slice and dice this stuff. So it's really important to work with your advisors before you actually make a decision. Rental properties, I'm intentionally vague on the slide because I don't want anything to be taken out of context, and bonus depreciation for rentals would need to be its own separate multi-slide presentation. But just for some context, I own multiple single-family homes around the country.
What is the website for 5 Tartan?
I think we have someone off mute, Darren. Okay. So I own multiple single-family homes around the country. They're all long-term rentals. I'm cash flow positive, but I don't pay any taxes on those profits because I report a loss for taxes. And the reason I report a loss on my tax return is because I get to depreciate that property over 27 and a half years, which is like the magic ingredient. So without even introducing the concept of bonus depreciation, that's already incredibly powerful from a tax perspective over the long term. So for 95% of investors, including me, those tax losses are called passive, which means I cannot apply them against my day job CPA income. I get to carry them forward year after year and use them in the future, maybe when I sell the property. But for landlords who meet very specific and strict criteria, there are ways to accelerate the depreciation when it makes sense to do so through bonus depreciation and apply those losses against other income. And realtors and realtor adjacent fields have a leg up on meeting some of those strict criteria. So for those of you who have rentals or are rental property curious, my message for today is to be just be very careful about making decisions based on all the bonus depreciation hype you see out there on the internet. And there's a lot of it. And a lot of it is also, it can be very powerful, but there's also a lot of misleading information. And I'm not a real estate investor because of bonus depreciation. I'm a real estate investor because I believe in the long-term financial and tax benefits that we get from owning real estate and renting out properties, including good old-fashioned boring depreciation over 27 and a half years, and not because of bonus depreciation. So bonus depreciation can be great, but it's not it's not always as good as it sounds on some of the webinars and videos you might see on YouTube. So happy to talk more about this on another for another meeting, but just want to at least just bring some awareness there. Okay, and then just last on this slide, beginning in 2026, the threshold for having to issue 1099 NECs to the IRS and vendors and contractors increases from $600 to $2,000. So if you ever receive, if you earn income, below 2,000 on something, you won't be required to receive a 1099, but it's still income to report. All right, I'm going to touch on some other key changes, and then I'll cover some commonly overlooked deductions. So there's a whole bunch of stuff in the new bill. And so again, I'm just trying to focus on the big stuff, but here's some of the other key things. 529 plans, historically synonymous with college, but no longer the case. The scope of what education expenses qualify for 529 funds has been expanded tremendously. So speak with your financial planner and then loop in your CPA. And again, Darren and I both know a really good one. But the whole idea here is it's not just about college anymore. Like I have to maintain a number of education requirements for my CPA license. And so I might consider a 529 plan because the scope has expanded where it's like I can potentially use 529 funds to for the education costs that I have to incur to maintain my license. So it's not just college, and trade schools are also fair game going forward. So it's much broader. There's some brand new deductions you've seen in the news: no tax on tips, no tax on overtime, no tax on certain car loans. And those are real, but there's multiple limitations. We're still pending some transition guidance from the IRS on how they'll actually be implemented and tracked and reported. There's the repealed deductions I mentioned earlier. I really like the energy efficiency credits that were out there. If anyone's looking to invest in a heat pump before the end of the year, there's still some good credits available that can be used this tax year. So feel free to reach out about that or talk to your advisor. And then looking ahead to 2026, yes, ladies and gentlemen, there will be Trump accounts. It will be, I'm not sure if it was a condition for him signing the bill to have Trump accounts, but it will be another financial vehicle to put dollars away for your kids, similar to an IRA. That's something, again, where there's still a lot pending there in terms of how that's going to work and roll out. That'll come next year, but it's just again, awareness that there will be an additional savings vehicle for your kids called Trump accounts. What was that? Okay. Alternative minimum tax. That's just something. So that's been virtually non-existent the last 7 years following the Tax Cut and Jobs Act, which will mostly continue to be the case. But starting in 2026, the exemption phase-out thresholds drop to 2018 levels and phase out at a faster rate than before. So the punchline there is that the last several years, it's been like 0.2% of the population that's been subject to AMT. So going forward, the percentage of people paying AMT will remain small, but will go up a little bit. And for any of you who have spouses that work for tech companies that get incentive stock options, in an environment with rising stock prices, it's just worthwhile to do some tax planning there. I think those will be the main people impacted by it. And then estate taxes, I'm not an estate accountant, but the good news is that the estates of people who do pass during 2026 will have a basic exclusion amount of up to $15 million going forward. So absent the new bill, that would go back down to 7. So there's more flexibility there. Okay, so I'm just going to, this is a slide I did not get to on the last presentation I did, but I was going to just pivot and just touch on some commonly missed deductions, overlooked or missed opportunities, I like to call them. So I'm going to kind of bounce through some of these. So first off, for anyone who's in a W-2 employee situation or has spouses as W-2s, one of the things I commonly hear is from W-2 taxpayers is who rent versus own that I don't have any tax deductions. And that's usually not true because 401k contributions are direct deductions to your taxable income. And so I had a new client last year, single filer, got a promotion in 24. His income was on the rise. He earned a little over $200,000, which put him in the 32% tax bracket. And he contributed like $11,000 to his 401k plan, which was basically just enough to take advantage of his employer match. But had he contributed another $12,000 and maxed out his 401k contribution, his taxable income would be $190,000 with a top tax bracket of 24%, right? So just by contributing some extra to 401k, he would have kept himself out of that big jump from 24% to 32% and saved almost $5,000 for federal and state taxes. So it's kind of like, do you want to give the money to the IRS or to the FTB or invest in yourself? So it's just 401ks can be a great way to reduce taxable income, reduce tax rates. For anyone with a high deductible health plan, HSAs are another great way to reduce taxable income, which basically stacks on the benefits of 401k, because you can max out those plans every year, use what you need for medical expenses, and then just carry it forward year after year after year, and actually use it like an IRA in retirement. For self-employed small business, which I think would be most of you, remember, for those of you who are Schedule C sole proprietors, you have to pay both income tax and self-employment tax of 15.3%. And that Social Security and Medicare really adds up on your net business profits. So first and foremost, if you are not tracking your business expenses throughout the year and waiting until year end to throw something together for your accountant, chances are you're missing and overlooking some deductible expenses. So just have a good system for logging and tracking expenses on a weekly or monthly basis. It doesn't have to be complicated. A good Excel worksheet often does the job just fine, but just timely tracking, because we're going to forget stuff if we don't log it now. If you drive a lot for business, which I think many of you do, I highly recommend using a mileage app. Mileage IQ is I hear good things about that one. But in the view of the IRS, if your miles are not logged and documented, it's viewed as not happening. And so during IRS audits, that's one of the first things that the auditors will look at is, do you have a mileage log? Home office deduction. It's a great way to take credit for expenses you're already incurring with the home you own or the apartment you rent. There's many people out there who don't take it because their accountant says it's too risky. And if that's the case for you, then I would encourage challenging that or getting a second opinion. Now, yes, if you have a $1,000 square foot apartment in your office and you say your home office is 700 square feet, that's likely an issue. But it's very acceptable and legit deduction as long as you're reasonable. And and just in terms of it doesn't increase the risk of audit. I'll just share that the number one reason that I amend prior year tax returns for new clients is the home office deduction. And on the front page of the amendment, when it says, why are you amending this return? One of the reasons is to claim the home office deduction that was previously admitted on the original filed return. So it's right there for the IRS to see. I've never had an issue with that. Retirement plans for sole proprietors are supercharged because you can contribute as both employees and employer. It does not reduce the self-employment part of your taxes, but it can make a big difference for income tax. So it's like contributing as both employee and employer, you can really supercharge contributions, reduce taxable income, and financial advisors can work with you to identify the best plan for your business and your tax world. Vehicle expenses. Most people use the standard mileage rate, which is 70 cents for 2025, because it's easy. And that's true. It is easy. You just take your business miles times the mileage rate, and there's your deduction. And sometimes that is the best answer. But especially when it comes to flashier vehicles, SUVs weighing over 6,000 pounds, which I was just talking about, you may be leaving money on the table, missing out on things like bonus depreciation. So it's important to look at both methods, both now and versus over the long term, and see what gives you the best outcome. So planning ahead. And then finally, getting your teenage kids off their darn phones and putting them out of their rooms and putting them on payroll. If you're already giving your kids, if you have sole proprietorship, small business, and you're already giving your kids a nice spending allowance anyway, why not hire them as W-2 employees and get a business deduction? Kids can be IT experts for you. They can help hang signs for homes for sale. They can help us the staging process. So, and there is some investment here. You need payroll software. Like Gusto is a great software for sole proprietors. You need to have their job responsibilities documented. You have to pay them a reasonable wage. They have to track their time. You need to basically treat them as real employees, even though they're your kids. But it's an example of how you can think more creatively about business expenses while still coloring within the lines. The question is not, can I deduct my kids? The question is how can I deduct my kids? So again,
Brian, I have a question about that.
Yeah.
Don't you have to add their income to your income because they're dependents?
No, they can file as their own person. And by the way, like if you pay them a salary that's less than the standard deduction, so the standard deduction for federal is $15,000 or so, and you pay them less, you basically pay them the standard deduction, they're not going to owe any federal tax anyway.
Okay, I need to talk to you more about that because I think I've been given different advice.
Okay. Yeah, sure.
Can I add one thing to that, Brian?
Sure.
Great idea. Great idea is to pay them the amount that you would put into a Roth for them.
Yeah, right. You can pay them as long as they're working employees, they can you pay them a salary, and then they can take that salary and start a Roth at a very young age, which is huge over the long term. It's a great point. So yeah, so it's all like, hey, if I'm already giving my son or daughter $500 a month, let's make them earn that allowance, learn work ethic at a young age, and then you get a tax deduction for it. So it's a win-win. But again, it does require some upfront investment as far as the payroll software, good documentation. and so on, because they are a related party, right? They're your kids. So you do have to make sure that you have all the good documentation to just to support them as legit employees. But anyway, so this is just a list of things that I commonly come across where I see an opportunity for my clients to save money on their taxes, both now and going forward. And all this stuff really adds up. So with that, that's so I covered everything I'm planning to cover in this presentation, but I'm happy to take, I know we just got a couple questions, but I'm happy to take any more questions.
Hey, Brian, there's one on here. Susan said, what mileage app is recommended?
Yeah. So Mileage IQ is one that several of my clients like and use, but you can just look up they all have like their own pros and cons in terms of the cost versus they all have like their own promotions, but Mileage IQ is the one I hear the most good things about. But you can just look it up online and you'll see several different options, and you could try out a couple of them for a month and see which one you like the best. And just the most important thing is just making sure you document your mileage. But for very busy people, like if you don't commute very much, like it's like, okay, maybe an Excel spreadsheet does the trick for a mileage log. But if you're commuting a lot, you have a busy schedule, always on the go, boy, that mileage app saves a lot of time.
And then one other question on here was, instead of teenage kids, what about retired spouses? I'm not sure what she's referring to on that part. And if you're on, Susan, you can, I don't know if she's still here. Oh yeah, she is. You could go off mute and ask, but if not,
yeah, I mean, generally you can pay. Yeah, I mean, you can hire, anybody as long as you meet the appropriate criteria. I don't see an issue with that.
Paying to do work, deducting that. Susan, paying to do work, deducting that. So is that? I just want to make sure you're getting your question answered. You could go off mute if you'd like, but if not, any other questions? So hey, real quick. So going back to the kids' age, and I'm sure it doesn't. So I think you answered this, but it doesn't matter the age of the kids. They could be under 17 or mid 20s. Anything?
Sure. Yeah, I think you just got to double check that the California may have some extra criteria there, but it's like my clients who have the kids on payroll, they're all like they're 15, 16, 17, 18 in that range. If they're below 18, you don't have to worry about withholdings for Social Security and Medicare.
Oh, okay. And then I wrote down something here also as far as like when I'm doing my pre-approvals, I want to somehow throw in that the SALT deduction that's coming up for them, going from 10,000 to 40 or 50,000. That's a big difference. Which you've talked about before, and I caught that, but just for some reason it clicked that this is something that we could put into our presentations or I can, and realtors as well, when you're doing a presentation or whatever, that you got a huge deduction coming up that you didn't have before.
Right, potentially. It again just kind of depends on their their own facts and circumstances with, because ultimately you want to make sure you have, through your mortgage interest, your charitable donations, and whatever SALT is applicable, it needs to be enough to exceed the standard deduction.
I think what I'm going to do going forward is just a lot of my clients, I'm going to have them set up a quick 15-20 minute call with you as well.
Yeah, sure.
Just to see where they're at. I mean, if anything, it'll
yeah, one thing I've noticed is people, because this has been, the new bill came out in July, and there's been a lot of attention on the SALT deduction, but it hasn't. The fact that it applies for 2025 and what it actually means in terms of potentially increased itemized deductions hasn't clicked for a lot of people yet. It has for some, but it's like everyone's gotten so used to this annoying $10,000 cap, which has been in place for many years now. That it's just kind of, you just get used to Yeah, I'm just going to continue to take the standard deduction, or I know I'm going to continue to have this cap. I'm not going to get. It's just it hasn't fully been. It hasn't
Yeah.
fully resonated with people yet broadly in terms of how
No, that's
much
good.
because that can make, again, 32%, $30,000 at 32%. I mean, that's almost 10 grand. That's a huge save.
Course of this campaign that you did.
Hello.
Any other questions?
You have learned.
Of course, we have our study full with it.
So let me see, Susan, I got to put you on mute. Okay, any other questions, guys? So my thing is, obviously, Brian, I have the bat line to you. So a lot of my questions, I'm just going to call you, which I know I'll have them going forward. But everyone else on this call, obviously, you can reach out to Brian anytime or to your CPA and get any questions that you have answered. There's so much, and I think I said this at the beginning of the call. I mean, there's so much that I've missed the last 7-8 years on my tax deductions that luckily we can catch up on some of it. But talk to your CPA or talk to Brian or whatever, just get your questions answered, because there's a lot of stuff out there that's just going to save us some money and take us into that. Because Megan and I were at, this tax bracket, and we did a few things and got us down to this tax bracket, which saved us a lot. So it's definitely worth the call.
And I would say right now, so we're in September, Q4, just around the corner. I mean, this is a great time to just connect with your CPA, your other advisors, to do some projections for 2025. Where are you expected to land in terms of your total gross income for this year? And what does that mean in terms of a lot of these new things that I just described? So again, going back to for those who are a little bit over 500,000 or trending in that direction. Okay. Because for those of you who have, great combinations, for couples that have a combination of self-employment, small business, 1099 income, and then the other has W-2 income, there's that business income gives you a lot of flexibility in terms of things you can do to bring down your total income. So it's just look at, okay, where do I project, where am I currently projected to land for the end of the year? And based on that, what can be done, just going through my different sources of income, what can be done to leverage things like the SALT or front loading my charitable contributions, if it makes sense to do that. So there's a lot of things to look at here for 2025, because once you get into tax season, February, March, there's really only so much you can do. Yeah, there might be things you can do as far as increasing your contribution for your self-retirement plan, but there's it's just a handful of things that can be done at that point. So it's just now is the time to see what Q4 moves can I make to maximize my tax savings for this year. So I don't have, I shoulda, woulda, coulda in April.
All right. Well, we're just about out of time, guys. So Brian, thank you so much. So we got your contact information here.
So Brian at bigcitycpa.com is my email.
So shoot Brian an email if you have any questions. And this has been recorded. Now you have the deck page. Do you share that, or is this something that you can, Brian?
I can send you the deck, Darren, if you want to. If you're welcome to email it.
Okay, yeah. If anyone wants to see that, just let me know. Just shoot me an email. Reach out to Brian if you have any questions. And guys, a reminder: I sent out the Evite for 2 weeks from today for our next buy sell meeting. If you were at the last one, you saw we had probably 120 agents in there, so this one will be good as well. So, Brian, again, thank you so much.
Thanks for having me.
If you guys have any questions, please reach out to Brian, myself, whatever, and we'll get you handled. So, thanks everyone for joining. We'll see you in a couple weeks, and talk to you soon.